Good morning. Good morning, everybody.
Very good morning, sir.
Good morning.
Okay, now we enter the last session. So we have to discuss one more thing, especially in the previous unit. We have one more thing, that is sensitivity analysis, followed by financial statement analysis that considering ratio analysis and interpretation of financial statement. It's the purpose is to get more insights from the company's annual reports. So that may target on the task 2, performance review and improvement. So I have shared a few materials. So almost those are right theoretical part, right? So based on the data provided in their financial statement, we have to calculate some of the ratios, and we try to find some meanings on that. Okay, now the part, so we stopped there in the sensitivity analysis. Sensitivity analysis, you know that we calculated NPV, net present value, with regard to the investment appraisal. Investment appraisal. Yeah, the investment appraisal. Investment appraisal mean they are going to decide long-term investment. Long-term investment. It's a lifetime, probably 2 to 5 years or 10 years and so on or more. It requires a very large amount of money, a big amount of money they are going to invest on this project. Before they start the project, they have to do comprehensive analysis, because it's not short term. If they make mistakes, the reversing the decision is very expensive. So that there are a lot of analysis they did. In that we studied different types of investment appraisal techniques, mainly payback method and accounting rate of return. So these two methods are not considering time value of money, right? So this is the major drawbacks. Then the most commonly used technique is called NPV, net present value, and IRR. Always NPV is superior than IRR. In the IRR and in the NPV calculation, there are a lot of things we talk about. One is what happened if there are any inflation. And inflation, how do we deal with this kind of inflation? Number 2, income tax. 3, income inflation plus tax. And 4, we talk about working capital. And already we talk about terminal benefit. So this kind of things we did. Anyhow, the sensitivity analysis mean, we forecast about the future, right? Forecast the future. We are going to start a project here, but we are here now, right? So we have to forecast about this thing, and we decide how much investment it requires, how much working capital by using this machine, or the plan, what the product we are going to do, and what's the demand of the product, and demand and the selling price and operational cost contribution, everything we forecast. right? So, and we calculate NPV. The thing is in the future, there are chances for deviate something. So one of them is inflation. We already incorporated inflation. Rather than inflation, right? Say the selling price. We expect that in the market we can sell a product for 200 rupees. We expect, but due to the heavy competition, we may sell the product for 180 or 150 something. If happened, right? If happened, what's the impact on NPV, right? Operational costs, say sudden fuel prices increases or material price increases, what happened to the NPV? And if employee salary hikes or other things, so what other things may happen? So that kind of things it includes, right? We can discuss in two ways. One is scenario analysis. Scenario, I mean economic, in case of economic crisis and high inflation or government regulation change and the global war or global financial crisis, economic sanction, right? Something may happen, employee strikes, right? Uh, may happen. So the management has to consider different scenarios, right? Scenarios, and they have to uh, test test their project appraisal against the scenarios, different scenarios, kind of simulations. Right? And the another thing is sensitivity. Sensitivity mean the NPV, right? NPV may differ, right? NPV may differ when uh, uh, 1% increase in material cost. In material cost, what will happen to the NPV? Or 5% decrease in selling price, what will happen, right? Some NPVs, right? Some variables are highly sensitive, highly sensitive. Right? If something change, little change, a small change, say for example, operational cost, or selling price of a product. If selling price decreases a small range, the vulnerability of NPV, right? NPV is very serious. Say, for example, if say 1% decrease in sales, sometime it leads to NPV become negative. NPV become negative. If NPV become negative, that is total loss, right? Ultimately, it make loss, right? So it's very important to keep, right, NPV positive value. NPV positive value. We studied now in the break-even point analysis, margin of safety. Margin of safety. Likewise, in the NPV analysis, we are not call them as a margin of safety. We call them as a sensitivity. Sensitivity. The formula for sensitivity analysis here, NPV, right? NPV divided by the variable, right? So for example, NPV is 500 and present value, right? The present value of variable, say operation cost like 550, right? And 100. And if you put them operational cost, you can put operational cost or present value of operational cost, or sales volume, you can put sales volume here, right? But always at the top, you have to put NPV, right? NPV. Small value of here, sensitivity, right? It's very risk, right? Small value of sensitivity, having high risk, right? High risk. So that we have to keep the sensitivity always reasonably high. And let's see, with this note, we will see in the handout. I have shared a handout, right? C333, the second section, page number 15. You can find sensitivity analysis. Before that, you can find some sort of risk and uncertainty. You can read and understand. That's very straightforward. But this is critical. In the NPV analysis, it's critical. Right. Sensitivity analysis. What is sensitivity analysis? Sensitivity analysis. Sensitivity analysis assesses, right? And assesses how responsive the project NPV to changes in the variable used to calculate NPV, right? For example, for selling price. If selling price go down, what will happen to the NPV, right? One particular approach to sensitivity analysis, the certainty equivalent approach, involves the conversion of the expected cash flows of the project to riskless investment amount, right? So, right, we invest a big amount of money, right? So if something change little, what will happen to the NPV, right? So before start the project, we have to assess everything. So that may lead riskless project. Sensitivity analysis is one method of analyzing the risk surrounding the capital expenditure. Why we call it a capital expenditure? Right, it's a long term. Right, we are going to dump a big amount of money in a project, so we call them as capital expenditure, long term expenditure. It's not like advertisement. It's not like paying salary to the employees. Right, not like that. It's a long term investment in millions, capital expenditure project, and enable an assessment to be made how responsive to the project NPV to changes in the variable that are used to calculate NPV. Right, most commonly used sensitivity. Right, sometimes selling price may got change. Right, we can't always calculate. Right, scenario. Right, is scenario one. At selling price 50 rupees. 50 rupees. What is the NPV? Selling price 51. What is the NPV? Uh, right. So we can't do this kind of calculation. We can, but in practical scenario, right, it takes a lot of time, unwanted work. So therefore, they introduce sensitivity analysis. So we can assess when selling price increase by 1%, what will happen to the NPV. So that kind of approach we are discussing here. And what happened if sales volume changes, cost of capital, right? The discounting factor, bank interest rate changes. So now bank promises at 10% interest, but later they made into 12% or 15%. So if they change, so what will happen to our NPV? Initial cost, investment, operating cost, and benefits or saving, sometimes called saving, right? So what will happen? We'll see. The basic approach of sensitivity analysis calculate. So the first step is to find the NPV in a given scenario, right? The base, sometimes we call them as a base NPV, right? So whatever the scenario they give us a base scenario. So we calculate first. We have to calculate the NPV under alternative assumptions to determine how sensitive is to changing the condition. The indication that's provided of those variable which NPVs is more sensitive. Right now, right here there are different scenarios. For each scenarios, we calculate sensitivity, right, and then we calculate the value, sensitivity value. So among these different variable, we have to calculate which variable is more significant, more critical. Right, sometimes operation cost may be critical. Sometimes selling price is critical. Sometimes sales number volume is critical. Right. So not all variables are critical, more sensitive. Some are more sensitive. very few variables are sensitive. We have to find them, right? The extent to which those variables may change before investment result is negative, right? The thing is, uh, we have to save the investment that achieves negative NPV, right? Sensitive analysis therefore provide an indication of why a project is might fail. Right, most of the projects are failed in companies because they fail to do sensitive analysis, or they have a different assumption on a sensitive, so they may undermine a particular variable. Management should review critical variables, right? Very important variables to assess whether or not there's a strong possibility of events occurring which will lead to negative NPV. Management should also pay particular attention to controlling those variables, right? If management found a particular variable is more sensitive, right? The management has to pay more attention to control such variable, right? For example, employee cost or selling price or material price. If they found as a critical one, management has to make a strong attention on that variables to which NPV is particularly sensitive. Once decision has been taken to accept the investment. Right, the simple approach is sensitivity equal NPV over present value. This is very important, right? Present value, right? Present value of the project, present value of the project variable. So it can be easily explained using an example. And this is very important, a note, right? The lower the percentage, is the more sensitive NPV to the project variable, as the variable would need to change by a small amount, make the project non-viable. This means like some variables give you a little 4.5 sensitive. It means small change in their variable will make the NPV negative value, right? Make the NPV negative value. So that if like it's like a margin of safety, right? We have to have a large margin. Likewise, we have to have sensitive should be high. The low values are high risk. Example, sensitive analysis. Kenny Co is considering a project with the following cash flows. So it has 2 years project. Initial investment it requires at the year 0 today, 7 million, and it has variable cost, right? Variable cost means the cash outflow, right? Variable cost, it may include salaries, wages, material purchase, electricity bill, everything, right? So variable cost. In the first year 2 million and second year 2 million. Cash inflows, some form of sales, right? Sales, cash inflow. And the first year 6.5 million and the second year 6.5 million. The net cash flow 2000 minus 6500 equal 4500, right? So this is the data have given. Cash flows arise from selling of 6500 units, each 10 per unit, right? Now the sales volume is 6500 per 10. So it's mean there we can find the count, right? The count is not matter here. And the cost of capital, current cost of capital is 8%. Measure the sensitivity of project to changes in variable. Now here, what are the variables we have? Initial investment is one variable. Variable cost is one variable. And right, cash inflow, sometime it is in the form of sales, right, in the sales or revenue, sometimes in the form of contribution. This is sales, this is variable cost. So difference is what? Contribution. Contribution come because of sales volume, right? And another variable, this cost of capital, right? So there are a lot of things here. Let's see, right? Now the solution, keep remember the formula NPV, right? The sensitivity equal NPV divided by present value of the variable, right? So we can't, right? We can't. So just if you just find the NPV and divide by the variable cost like this, it can't, right? So we have to make every cash flows in the present value form. The earlier term, what we do is we consider all cash flows and we convert all cash flows into the present value, the discount effect, right? Then we get a single row, right? Single row, we can get present value of the cash flows, but that will not work here. What we have to do is first we have to convert all variable into present values, right? Here you look at this present value of investment, present value of variable, present value of cash flow, present value of cash inflow, present value of cash flow, net cash flow, right? Right, discount effect, we know that always the discount effect year 1 is 1, year 0 is 1. Then 0.928, how do we got it? 1 over 1 plus 0.08 into the power 1. This is we get, and for the year 2, we make it 2, then we can get this. So that is discount effect. And the initial investment 7,000, right? 7,000 already we got 7,000 into 1, 7. So here no cash flows. The present value of variable cost, we got 2,000, right? 2,000 into 926, we can get this one, and 2,000 into 2 million into 0.87857, we get this value. Same way, we got 6,500 something. The present value EFST here, this, and second is this. Right now we deduct these values. The present value of net cash flow, this is initial investment outflow, and these two are the inflows, and totally the net value NPV is 1024, right? 1024. Now let's see the sensitivity of initial investment. Here, when you look at here, the numerator is NPV, that is 1024, right? 24. And the initial investment, how much here? Initial investment, present value of initial investment. Present value of initial investment 7,000 into 100, and it's 14.6, right? What does it mean? When, right, when initial investment increases, right, increases by 14.6%, NPV become 0, right? If initial investment increases by 17.6%, NPV becomes 0. Afterwards, NPV become negative value. Right, that's the things, right? The value is 14.6. Sales volume, right? Sales volume here, we couldn't find a PV of PV of the sales volume, but we do in indirect way, right? This is cash sales, this is variable cost, then the difference is contribution. So we take the contribution, and NPV and 12.8. Here, this thing, the sales volume, all right, sales volume always depends on two things. One is selling price, and number of units, and right. So one may change, right? Selling price totally here. They're talking about sales volume, sales value, revenue, and it's got 8.8. If selling price, if selling price go down by 8.8%, NPV becomes zero. That's a case. That's an interpretation. And variable cost, variable cost, 28.7. And cost of capital, right? Cost of capital. So now the cost of capital 8%. Now they are going to change the IRR, right? IRR, they take 15% and 20%. What could be the IRR? Right here, they calculate IRR. For that, we have to use the IRR formula, right? IRR formula, right? We already discussed this one. 18.56. If the discount factor become 18.56, NPV become zero, right? So this formula cannot be applied here. Right. So this other thing. Out of these, right, there are things here. Initial investment 14 is 12, 8.8, 28.7, like that. So when you look at this, which variable is highly sensitive, which is critical variable, which is critical, which is critical. Initial investment, sales volume, or selling price, or variable cost, or IRR. Cost of capital. Which one? Which one is more critical? Hmm? Which one is more critical? Which variable? Initial investment, sales volume, or selling price, or variable cost? Which one? Anyone else? Anyone else? Yes. So base current, have you there? Here I read this note. The lower the percentage, is the more sensitive to NP, right? Here, what's the lowest percentage? The lowest percentage is this sensitivity, right? Selling price 8.8. This is most critical. So the management should closely monitor the selling price. Little change in the selling price causes NPV negative, right? Am I audible to you all? Am I audible? Imran, Insaf,
Yes, sir.
am I audible?
Yes.
Okay,
Yes,
okay,
sir.
okay. Thank you. And what are the weaknesses of this approach to sensitivity analysis? Here, the main approach is, right? A main approach, we assume at a time only one variable got changed. This method requires that changes in each key variable are isolated, right? So only, so for example, in the practical scenario, in the sensitivity analysis, what we do is all other things are constant, say variable cost and selling price, operational cost, and employee salary, right? All of them are constant. Only one variable, like selling price, only varies at a time. When variable cost changes, other are remain unchanged. So this is the assumption we made. But in the practical scenario, employee salary also got high, and sales price also may go down, and variable cost may go up, right? So many variables may change at a time, right? So it's a very that this is a uh, um, this is the one of the main drawback of this sensitivity analysis, right? However, management is more interested in combination of the effect of changes in two or more key variables. Number two, looking at the factors in isolation is unrealistic since are often interdependent, right? Say, for example, if employee salary, right, if they need more salary and operational cost may increase, due to that selling price also go up, and fuel crisis, right? Many variables got changed at a time. Sensitive analysis does not examine probability, right? Probability that any particular variation in cost or revenue might occur. So they have, so the sensitive analysis does not have the prediction of, so there are 50% chance, 50% chance of selling price increases by 10%. There are 50% chances of reduction price of uh, uh, 5%, like that. So this kind of things we cannot accommodate here. Critical factor may be those which a manager have no control. Sometimes, right? Sometime we can identify the critical factor based on the lowest sensitive, but sometimes the management have no control over that variable. For example, selling price. Selling price mostly it's not controlled by the management. Sometimes material price, material price managers cannot control, right? Even though they are identified as a critical factor, management cannot control. The selling price of the product is depends on the market competition. If the company is monopoly or oligopoly, so that may, right, they can handle this prices, but not always controllable. In itself, it does not provide decision rule, right? Parameter define acceptability must be laid down by the managers, right? We cannot say that the variation is 8.8 sensitivity. So we can, whether it's acceptable or not acceptable, right? It's purely based on the management decisions. So there's no guideline. And also we have one more example. Here you can read, right? You can do by yourself, right? It's easy and straightforward. And right, there are a lot of examples. Right? For your assessment, only we need a sensitivity analysis, right? So that we can conclude this chapter. The second part, the final, right? The final unit is financial statement analysis, where we can find a lot of things that most are ratios, right? Introduction to the analysis techniques, introduction analysis techniques. Ratio analysis is very important, and there are different stakeholders and what are the needs and the limitation of financial analysis and question approach. So our focus mainly on the uh, ratio analysis. When we look at your assessment, here, here we have to comprehensive analysis, analyze the financial statement, analyze the financial statement of a business by computing the last 3 to 5 years. You have to take 3 to 5 years financial statement, and you have to calculate gross margin, net margin, current ratio, asset ratio, return on capital employed, working capital efficiency metrics, inventory days, receivable days, payable days, cash conversion cycle, and present them a tidy table with a small 10 chart. Right, so it's very easy, right? Among these all the assessments, this assignment 2, task 2 is very easiest one comparatively. And critically assess financial performance of a business by interpreting the drivers of changes in profitability, driver of changes in liquidity, efficiency, and return. Right. To answer this question, you should know rather, right, merely by applying the ratio analysis, right? You can remember the formula and you just calculate the ratio. It gives numbers. It give you numbers. You have to know the in-depth insights. In-depth insights, then only you can understand what are the drivers, what are the causes of change. So why companies' profitability go down? What is there any probability issues, liquidity issues, the management efficiency, return forecast, benchmarking with other companies, right? Benchmarking result on a selected competitor and credibly, right? You can benchmark with the competitor or the best organization in your sector like that. Finally, you have to write critically evaluate a set of decisions designed to improve financial performance, right? As a manager, you have to write a report. What's your proportion? An organization by proposing 3 to 5 actions with quantified impact where possible, setting smart financial target. Smart financial target, you must study it smart, specific, measurable, actionable, and timeline, realistic and timeline. um, Assigning owners timeline and specifying monitoring metrics and how results become communicated, right? So very simple one. So that you have to propose some of your ideas, proposals, right? Here you write one page smart plan and smart plan table, and it's very right concise narration, right, for each. So right, don't write much. So very careful on the here you don't want to write anything. Here you have to write the you have to calculate only the ratios, and if possible you can give one chart. So when you, for example, they ask you to get 3 to 5 years now, so year one, year two, year three, year four, then you can show some graph what happened in profitability, right? This is year one, year two, year three, like that you can draw a small chart, right? So not a big task, right? Anyhow, all assessments are very right, narrative, very concise, very pay attention very closely on the word counts and what they required, right? I don't want a bulk report. I need very concise, right? And let's look at right here in the ratio analysis, which cover everything. Introduction and analysis technique. Why we do need analysis? And each companies publish annual reports where you can find financial statement. With the financial statement, you can see balance sheet. Balance sheet now the new name is a statement of financial position, and profit loss account. Profit loss account. Now we call them as statement of financial performance. This is position, right? Statement of financial performance, and cash flow statement, cash flow, right? These are the three main out of five. There are these are the five elements from elements of financial statements, right? Financial analysis involves appraising, right? We have to assess appraising and communicating, right? You find some of the insight and you have to communicate the position, balance sheet, right? Position mean the company strong or weak position. Performance mean either company make profit or loss, that is performance. And prospects, so what is the future of the company, of a business, based on a given prepared statements and ratios. For appraising, right, we need ratio analysis, right? The ability to review, analyze, and interpret. Review, analyze, and interpret a set of financial statement is a key skill. Set of right? Set of financial statement, key skill, financial accountant. Analysis may involve any of the following things. Number one, vertical or horizontal trend analysis, right? Vertical, horizontal trend analysis, common size analysis, and ratio analysis. Right? So these are the three different categories of analysis. Vertical. Vertical mean you know that this is vertical, this is horizontal, right? Vertical this way, right? Up, down, right? Up, down. This is vertical, horizontal, right? East, west, east, west, or left, right, left, right. Vertical or horizontal trend analysis, which is best? So how do we apply this? Trend analysis, right? Trend mean throughout the period, 2020, 21, 22, like that. How the sales goes on, sales. This is trend, right? Trend analysis, increasing trend or decreasing trend. The trend analysis involves comparing financial statement, right? We compare financial statement. Vertical trend analysis is comparing, right? Comparing financial statement of one company from 1 year to the next year, right? Here we put year, right? We put year 2020, 21, 22, 23, right? For one company, for example, company X company, the profitability, how the profitability goes on down, right? So that is vertical analysis. Vertical analysis. The horizontal analysis is comparing financial statement of one company with those of equivalent to another company. Compare with, right? The horizontal analysis comparing the company performance with competing firm or other similar firm analysis. Compare, right? In your life, you compare your career path with your friend, with your colleagues, right? That is horizontal analysis. Compare your career path by yourself, comparing you are earning 10 years ago, you're earning 5 years ago, you're earning last year, you're earning this year. What's the potential of your earning by next year? This is vertical, right? Right, vertical and horizontal. This type of analysis involves comparison. A comparison has the following drawbacks. A vertical or horizontal has some of the drawbacks. The first one, the financial result of 1 year may be skewed, right? For some period, companies make huge profit, right? Due to some of the events like political change or new technology introduction or some sort of COVID-19, right? In the COVID-19 pandemic, most of the companies' performance go down, but some companies here go up. For example, technology, mobile phone, laptop, right? That communicate. Then what do you call internet charges, router. Those things perform high, right? Other sectors go down. So some extreme, right? Some extreme events may give skewed results. Right? The financial result of 1 year may be skewed by a significant event, making comparison with another year less meaningful. Right? If we compare the profitability of mobile manufacturing companies in COVID-19 also COVID-19 with this year, it's meaningless because in that particular period gives something better solution, a better improvement for for some period was to the company, disaster to the company. For this reason, it's more useful to perform vertical analysis over extended period of time, not just compare. not just compare with 2 or 3 years. So to overcome this kind of significant event, we can have a long video. That's why when you look at the annual report, they give you summary, at least 10-year summary, 10-year summary, so that you can see the trend of the company. So that is vertical. An equivalent company that is a company of a smaller, similar size in the same industry may be difficult to find. And if one is found, it is the result of particular year may again be skewed in this particular event. For example, Ceylon Tobacco Company, right? There's no similar companies in the same sector. It's very hard. So it's very difficult to find a similar company uh, in their for horizontal analysis, like shell gas, right? LP gas, no competitors, right? Mostly, and there are some other product, no competition. Even dialogue after acquisition of Airtel, no comparative, right? The thing is the Mobitel, right? It's a private company. Hutch it's a private company, so they're having small market share, but the dialogue, right, having become a monopoly, right, in some of the sales. When you look at the prices nowadays, they make right the big no big since no competition. Earlier, Airtel considered as a competitor. Now Mobitel network, Mobitel, right, they didn't do a great job, right? At the moment, the dialogue, right, dominate the market. Now, right, so due to this kind of problems, the solution comes common size analysis. Common size analysis. Say, when you compare dialogue with Hutch, right? Dialogue cannot say our profit is high than Hutch because Hutch is a private company and Dialogue is a PLC. It's not meaningful, right? Uh, so that to avoid this kind of issues, right? Sometime some year we have right in the vertical analysis, in some year a huge profit, some year huge loss. Right? So to avoid this kind of things, uh, the solution is common size analysis. Common size analysis mean, right, they make all values and the standard, like uh, say the dialogue revenue may be 2 billion rupees, Hutch maybe 5 million, right? So they may have different cost of sales or operating profit. They may have different profit. They may have small amount. They may have large amount. So comparing these two, right, even though in the same industry, same sector, right, its comparison is unrealistic. So that make it common, right? Common to make 100 rupees sales revenue, Hutch company, how much they earn, right? From 100 rupees sales, from 100 rupees sales revenue, how much they make operating profit. And also compare 100 rupees revenue by dialogue, how much they are going to get profit. So now they make so common, right? Standardized 100% sales of both companies converted into 100%. For 100 rupees revenue, how much of profit of dialogue and Hutch. So this kind of things. So this is called common size. The common size analysis again involves comparison either of the same company, right? Same company, so vertical in a different periods, different companies in same period. This is horizontal, right? It's common size. In this case, however, comparison is not the raw numbers, right? Earlier, raw numbers mean the sales, cost of sales, gross profit, net profit, the value. We took the value directly, but now, we take we convert the raw value into some sort of percentage. Right? not the raw numbers presented in the final statement. Instead, a common base figure, right? Common base figure is adopted, like 100% of sales. Adopted, and amounts are expressed as a percentage of the base number. This is the base. For example, sales is the base. These percentage are then compared. A common base figure when analyzing statement of profit loss account is revenue. Revenue means sales. Common figure is sales. What we do is here example of common sized analysis. Common size analysis. The following example shows the result of one company for 2 years, right? This is vertical common size. As they gave us the revenue, sales, and cost of sales. Then we get profit. After that, distribution cost, admin, operating cost. Then we get finally this one. Yeah, this year, 100 million sales, and the profit, retained profit is 20 million, right? This is in 2019. The previous year, like this, right? Now we comparing. So this we can say 90 million, now 100 million last year. So we can say that the sales goes up. But here the common size mean we convert this 100, sales is 100, this is 90,000 considered as 100, right? Now 35%, 35,000 cost of sales, right? Now the cost of sales is 35% of revenue. Distribution cost 20% of revenue, and finance cost 5% of revenue, right? So in 2009 for a particular company. We compare this value with the previous period. Now you see that this 30,000, 33% of revenue, and distribution cost 18%, 18% of revenue. You see, you can see some small insights by comparing this. The distribution cost increases, that increases by 2%. Then only they able to increase their sales. And see admin cost 15% early, 15% this year, but last year 23% of revenue, right? So now the administrative efficiency has increased, and this year they increased their what do you call marketing expenses and advertisement. Finance cost earlier 3% of revenue, and now 5% of the revenue. And tax last year paid 4% of the sales, and this year 5.3. So this is called common size. As the revenue in the company has increased, it is followed that cost might increase, right? Cost might increase. Common size analysis help to identify whether costs have increased proportionally, right? Here, proportional increase. Here, sales increased by 2%, but profit increased by only how many percent? So we cannot expect proportional, like the admin cost here. Actually, the revenue increases, but admin cost reduces 23 to 15%. Finance cost increases, others are increased, all others are increased, but the admin costs are decreases. So we cannot say that 5% increase in sales, it doesn't mean 10% increase in admin cost, 10% increase in sales cost, 10% increase in finance cost. We can't say like that, right? Questions that might ask as a result of performing this analysis, right? We need analysis. What are the analysis we should do? Why has cost of sales increased, right? Why cost of sales increased as a proportion of revenue? Have selling price reduced while cost per unit remain the same or cost also increased, right? They have to investigate cost of sales aspect. Second, why have distribution cost, something like advertisement, increased as a proportion of revenue? Have costs such as petrol increased or are proportionally more items being distributed? Distribution cost, the distribution cost increase because of advertisement or fuel cost increases. They have to do the investigation. There is significant drops in the proportion of revenue spent on admin expense, right? Admin expense. Is there a one-off item of income in 2019, or was there a one-off expenses in 2018, right? Sometime admin cost may same as last year, right? Unexpected revenue may increase, unexpected increase, or sometime unexpected admin cost increased in the last year, or this year unexpected increase or decrease in the admin cost. So there are chances. And finance cost as a proportion of revenue have increased. The company appears to have borrowed money in the year, so this has been employed in their business result in the right. So there are a lot of reasons. So here, what we discussed is what is vertical horizontal analysis in normalities. So there are some sort of drawbacks. Then we move to the common size. Common size mean we standardize the figures. After standardizing the figures, we compare the vertical analysis. It's mean one company in different time period, or common size analysis horizontal. So they convert the figures into standards, say 100 of sales, and compare across the company. So that is common size vertical, horizontal, right? So that's the thing. Now we move the most important one, the ratio analysis. Ratios. Ratios mean like this: A over B, right? Into 100. This is ratio analysis. Let's see one by one. Ratio analysis involves using amounts from financial statement, right? You can pick some values in the financial statement to produce a ratio and comparing it with the same ratio of any of. You can compute the ratios. You can compare the ratios with same company in different years. This is vertical. Different companies in the same year, horizontal, and benchmark industry average. There are 5 categories of ratios. One is profitability ratio, long solvency ratio, short-term liquidity ratio, efficiency ratio, and shareholders investment ratios, right? So there are 5 categories. There are number of ratios we can calculate based on the financial statement, but for your level for assessment, these five categories are sufficient. Right, now we move to the second section, ratio analysis. 1 minute. right? Ratio analysis. Ratios can be grouped into five categories, as I told you earlier: profitability, solvency, right? Liquidity, efficiency, and investor ratios. Right? For each categories of ratios, different number of standard, right? So that you can read and understand. It is also important to remember that ratio analysis on its own is not sufficient for interpreting the company accounts, and there are other items of information that should be looked at. By just looking at the ratios, right, you cannot assess the company performance. So liquid solvency, you should consider other aspect as well. For example, forthcoming technologies. Now AI play major role. Some companies may be disappeared, some job also may disappear, but this kind of information you couldn't find in your financial statement, right? So that you have to consider this aspect as well. The content of any accompanying commentary on the financial statements and other numerical informations are provided, right? The age and, right, when you do the analysis, you have to consider the age and the nature of the company, right? Some are very, right, very old companies like George Stewart is the first company in Sri Lanka, right? George Stewart. So it has history more than 100 years, 100 years, but unlisted, unlisted company, private company, George Stewart's. Right? We can't compare the very old company with very new startup, right? So you have to consider and the nature of the company. I'd say some are involving in banking and insurance, some are in manufacturing. We can't compare these two type of companies. Current and future development of the company's market, right? Companies need perspective about the future. The home and overseas, the local and global uh, scenarios like Donald Trump's tariff, right? Tariff has made a significant impact of many businesses around the globe, including Sri Lanka. So that kind of thing you couldn't find in the ratio analysis. Recent acquisition like right, Dialog acquire Pattern and Google acquire at YouTube and other companies. So this kind of things may happen. You have to consider all of that things as well. Unusual items separately disclosed in the financial statement, like fire accident, fire accident, or employee strike, or any expollution, right? May happen. That unusual things, and also sale of particular unit or sale of one particular plant, right? That may occur in one time in a particular period. So that also you have to consider. Any other noticeable features of the report and account, such as events after the end of reporting period, right? If event after the reporting period, say um, there are cases against companies in the court that cannot be disclosed in their financial statements, right? Something may happen end of the financial period. Say financial period normally 1st of April 2024 to 1st of 31st of March 2025. The report can be published within 6 months. 6 months, right? 6 months mean 9th, right? April, May, July, August, September, right? September. So within this gap, something may happen. So this 6 months is given for audit and other verifications, right? Finalizing the final accounts. Within 6 months, something may happen, right? Sometimes merge and acquisition and other things may happen. That also has to be considered. Contingent liabilities, court cases, and it may owe to a huge payable like that. Qualified auditor report and sometime adverse opinion. Qualified report and company tax position and many things you have to consider when you do the uh, financial statement interpretation. Right. Let's see. Right. We have one comprehensive example to illustrate the financial ratios. To illustrate the calculation of ratios, the following statement of financial position, balance sheet, and the statement of profit loss, right? Profit loss account, statement of financial performance will be used. We are using the separate statement of profit or loss of this example. No items of other comprehensive items are involved. Right here, uh, extraordinary items like sale of land, merge and acquisition, right, and fire. So those kind of things are not considered here. So this is the common, right, separate financial statement. Here you can see the notes, and this is current year, this is last year, and you may see that revenue in thousands, right here 3 billion, 3.095 billion. Now operating profit they give notes in one, and revenue also notes in given one, interest given in the note two, and the VAT so are given, right. Here revenue, operating profit, interest, profit before tax, this value, income tax expense for the period, profit for the period, and the earning per share, right? When you look at the financial position, right? Position, they have assets and two non-current assets and current assets. Current assets, you may have inventory receivable, cash receivable, and you can see the notes detail about the receivables. And you have total assets of these each. Now the second section, equities and liabilities. In the equity, there are two things, stated capital and retained earning. And the non-current assets, they have only one item, that is 10% loan. So there's no changes. And current liabilities, you can see, right? Current liabilities, you can see the note number 4 for more details. So assets and liabilities are equal, right? So these are the information given to us. The note under the sales, note 1, you can see the sales revenue, cost of sales, gross profit, admin cost, operating profit, right? So this figure has given to you. In addition to that, how much depreciation cost, non-cash item. So this figure you can find there, 359. Yeah, 359. That is operating profit. Likewise, you can find the details, the note, interest note 2, and receivable note 3, and current liabilities note 4. And dividend paid. Last year, no dividend. So this year, 20,000 dividend they paid. Right. Based on this information, right? Let's see section 1. We look at profitability ratios, right? In your assessment, they are asking about the profitability here. They're talking about the profitability, right? Gross profit, net margin. So those are profitability, right? Profitability. Yeah. In our example, the company made a profit in both 2018, 17, and there was an increase in profit between 1 year and another year, right? So which one is the gross profit? Gross profit increased by, right, 48%, and profit before interest and tax increased by 47%. Profit before tax increased by 52. Profit after tax 39. How do we calculate? Here, gross profit. This is the gross profit. Gross profit margin, right? Here in the note you can see gross profit. How do you calculate gross profit? Increases. Say, so this is the gross profit. Gross profit. How do you calculate? First, we have to find out the difference and the base value, right? Difference and base value. So 692,967 minus 467,101, right? Divided by this value, base value 467,101 into 100, right? Then you can get the value of this gross profit margin increases, right? Almost half, right? Almost half increase. When you look at this, you can realize this. You know, here almost half. This is almost 7. This is almost 4.5, right? 50% increases, almost 48%. So that's how each values are calculated. Let's see. The depending on the format, right? So we did here. This is trend analysis. Trend analysis. We just report when we compare to sometimes called an year-on-year analysis. Year-on-year analysis. Now we look at gross profit margin. Depending on the format of the statement of profit or loss, you may able to calculate gross profit margin. So gross profit margin may be calculated in this way: gross profit over sales or revenue into 100, right? Sales or revenue, and gross profit divided by revenue into 100. It's mean for each 100 rupees sales, how much profit. So that is the thing, right? So this sentence is important, right? This text block is important. By just looking at the ratio, you couldn't get insights. So there are a lot of reasons. Why change this gross profit from other year, right? This the the cost of this margin, right? 48% increase from last year to this year. Gross profit. So what are the causes? The result and margin indicate how well a company has traded. The margin can be affected by only 3 things, right? When you talk about the profit margin, you have to think a variation in average selling price. So this year the company may increase the selling price. Variation in average cost per unit, right? This year maybe cost may go down, right? Then the last year, the changes in product mix. Sometime this year a company may introduce a new product with a large margin. So that also may cause of making huge gross profit margin. So in this example, gross profit can be found in note 1. The gross profit margin deteriorates slightly. So earlier it was 24% in 2017. Now it's 22% in 2018, right? Gross profit margin, right? Gross profit margin is different from here. When we talk about gross profit here in the absolute term, right? The value term, it may increase by 48%. But when we calculate in the gross profit margin compare with the sales, it is a reduction, right? 24 to 22. We can work out on that. So we have very limited time to discuss rest of the thing, right? Here, how do you calculate gross profit margin? Here, gross profit 692 over sales value 3095. So likewise, we have to calculate this. Then you can find out this year 22%, and this year 24%, right? In that way, you can calculate. So now we have to need the reason. Management has achieved an increased revenue 62%, right? Compared to the last year, this year, sales revenue has increased by 62%. However, cost of sale has increased by 67%. You see, sales increased by 62, but cost of sale increased by 67. Cost is increased higher than uh, the sales, so leading the drop in margin. The increase in the revenue may have been achieved by dropping price, right? They reduce the price and the volume, the number has increased. So affecting the gross profit margin, right? Or cost may have increased disproportionately due to the supplier power or general general raw raw material prices increases. So Pacific may have expanded its product range and introduced new lower margin products. So this could be maybe the reasons. But you have to brains analyze like that. Operating profit. Earlier we talked about gross profit. Gross profit means directly uh, sales minus cost of sales. Gross profit. And operating profit mean, right? So gross profit minus admin cost, sales and distribution cost, right? When we deduct these two costs, we can arrive operating profit. Operating profit. Operating profit is generally throughout to be better figure to use for analysis than the profit before tax, right? So you can read it. Now the operating profit margin calculated this way. Operating profit divided by revenue into sales. Here, for each 100 rupees sales, how much operating profit? How much operating profit? So that is called operating profit margin. Right. In the example, the operating profit margin was 12.8% in 2017. Now it is 11.6%, right? As this fall is less than the fall in the gross profit margin, right? Earlier gross profit margin 22, 24, 22. And operating profit margin this year 11.6. Earlier it was 12.8. When we compare this, right, the fall, right, it's 2% variation, 2%, right, 2%, but here very less, small margin, around 1, almost 1%, 1.2. As this fall less than the fall in the gross profit margin, then management is growing the business while keeping the tight control over the admin expenses. Even though, right, there be the uncontrollable cost of sales and other things, now the management has, right, pay a great job. and play a great job on controlling admin and other related costs. So therefore, they're able to make they make stable on their profit, operating profit. Right. So there's a relations between interaction of gross and operating profit margins. So there's a link. Looking at the gross and operating profit margin together can be quite informative. You just looking at gross profit margin solely or operating profit margin solely, it will give you not give you any insights. You have to consider both together. For example, suppose that a company has the following summarized statement. You see, it's another example. You see here, the last year 70, and this year 100, and gross profit 42, 55, like that. Operating profit 7 and 10. But when you look at the operating profit, right, 10% this year, and also 10% this year. So no changes in the operating profit. Although the operating profit is the same for both years, the gross profit margin is not the same, right? The year one, the gross profit margin is 40%. Here, 40%. And the year two, right, gross profit margin 45. The improved gross profit margin has not led to the improvement in their gross profit margin, right? So this is right? So in year two, they have a lot of the huge gross profit, but they able to achieve only 10%. But the last year, less gross profit, but they able to manage 10% operating profit. So what could be the reason? Not proportionally increased. So this is because operating expenses, right? Operating expenses as a percentage of sales have risen 30% in year one, but it 35 in year two, right? So they are unable to manage operating costs like admin cost and sales and distribution cost. So this should be investigated further as it may be skewed by one-off expenses. So one-time expenses like redundancies. If it is not the case, there are indications that management may not have performed well in terms of cost control, right? The cost control issue. Even though they make a huge margin, gross profit margin, they are unable to manage operating profit because of what? Because of their operating efficiency. The management fails to control the cost. Right. Under the profitability, the most important, another one is most commonly used return on capital employed. Return on capital employed. When we involve, right, when we invest a big amount of money, how much, what's the return on this investment, bulk investment? So that is return, profit on our capital employed. Capital in uh, two forms, equity plus debt, equity plus debt. All this together, we call them as capital, ownership capital and external capital, loan. So the formula, return on capital employed formula, operating profit, normally we take operating profit and total assets minus current liabilities, right? Current liabilities. Capital, normally we consider capital, we consider long-term investment, long-term equities, long-term equity plus long-term loan. We are not consider current liabilities as it is a working capital. So total assets minus current liabilities. In other way around, we can say shareholders equity plus non-current liabilities. This means long-term liabilities. Long-term liabilities, not current assets. Or total assets minus current liabilities. We can say capital employed in this way. Right. In our early example, in 2008, right, our example capital employed, how much they employed the capital. This is total assets minus current assets, current liabilities. In the previous year, this is total assets minus current liabilities. So this is the amount capital employed, both, right? So you can take the same figure, equity plus long-term liabilities or non-current liabilities, right? Without considering the current liabilities. So these total figures are the total assets minus current liabilities. Here you see return on capital employed. You can take this value as R capital employed and these values. And this is operating profit. When you look at the operating profit, you can see 35. Return on capital employed 35. In 2007, return on capital employed 31. Right here, almost 4%. 4% improvement. Right, 4% improvement here. So what does the company's RO, return on capital employed, tell us? So what the meaning? What the meaning of this 35 and 31? The return on capital employed of 35.6 means that for every 100 rupees of capital invested in the company, management create 35.6 rupees of profit. Therefore, return on capital employed is the measure to assess how well a capital is used by the management to generate profit. Or if we invest 100, we can get return as 35.6 in that year. And this year, if we invest 100 rupees as an investment, we can get 31.8. So the company performs better than the last year, right? So what should be looking for, right? You just looking at these figures, you can't come to the conclusion. You have to look at some other aspects as well. What should we think? What we're looking for? So there are three comparisons that can be made when we look at ROC. Right. The first, the changes in ROC from 1 year to next can be examined. In this example, there has been an increase in ROC by about 4%, right? The ROC being earned by other companies, right? We can compare this ROCI with another companies. Most suitable one is competitor in same size. If this information is available, can be compared with ROC of the company. Here the information is not available. Comparison of ROC with current market borrowings rates. Right now, the company give you 34%, 2% or something like, right? ROC employed. When you go for a bank, right? The bank may give you 12% or 10% or 18%. Then you can compare, right? For each 100 rupees loan, we have to pay this amount of interest, but our company earn this amount of income. By comparing these two rates, the company may come to the conclusion, right, whether it's profitable or not of getting the loan. What be the cost of extra borrowing to the company if needed or more loans, right? If the company makes ROC that suggests that it's getting value for money in the current borrowing, and companies are in risk business. Companies are in risk business, and commercial borrowing rates are good independent yardstick. Some right. So it's the ROCE may play a different role when they go for additional loan. Right, it is capable to pay loan or not. Right. So that's what they are telling here. In this example, if I suppose the current market interest rate, say medium term borrowing loan around 10%, then the company ROCE 35.6 would not seem low, right? So this is not a low value, right? So that the company can borrow. You should be aware that return on capital employed can be skewed by the effect of accounting policies, right? Sometimes called window dressing. Window dressing, right? So it's a separate area of discussion. Window dressing mean that even though the company performs poorly, the management manipulates some of the information to show the company is fine, great. For example, right, property revaluation. Sometimes company may reevaluate the assets. Uh, Say for example, land that they may purchase 5 years ago. Now the land price is go multiple times up. Then these abnormal things may uh, give you a wrong signal, right? You are not sold the land yet, but right, it gives some sort of illusion that company give a huge profit. However, will not result in addition resources being available to generate profit. Profit are therefore unlikely to increase proportion of capital employed. As a result of ROE will fall, right? In this situation, normalize the ROC calculator, right? When you are talking about return on capital employed and other profit ratios, you should consider how the company generate profit. So by normal operations, by producing and selling, or by selling the assets like land and machine, and they are not operations. So by selling their existing machine or the land, they can make a huge profit. This profit is attributable to only for that year, right? By looking at this ROCE, we cannot take decision for getting loan or something like, because these are not continuously occurring, not frequently occurring. Right, return on equity ratios. Right, shall we continue after the break? 10:45. Shall we continue at 45? Okay. Okay.
Yes, sir.
Thank you. Okay. Right. Right. So, right, we can continue. Right. Next, very important one, return on equity. It has small difference between return on capital employed and return on equity. Right. When we talk about return on equity, we consider both, right? We consider uh, capital. Capital will include equity plus debt. But here, return on equity consists only equity. The shareholders fund only. That's a different. So return on equity here, the formula. So earlier in the return on capital employed, we considered only operating profit. But here it includes only profit before, profit after tax. Profit after tax. It does not include interest cost and interest cost, right? So here, very important, profit after tax. And if there are any preference shares, all that also has to be excluded from the thing, right? Profit after tax divided by equity shareholders fund. Equity shareholders fund include equity stated capital plus any other reserves and any retained profit, right? So this is very restrictive formula. In our example, ROE is calculated as follows. So this is profit after tax. And this is equity, right? So accordingly, we got return on equity 29.4. This is 29%, right? Almost equal. Return on equity is not widely used ratio. However, because there are more useful ratios that give an indication of return to shareholders, such as earning per share, dividend per share, dividend yield, earning yield, which are described later, right? In the next part, investor ratio. When we talk about investors ratio, we can discuss these things. Right. Analyzing profitability and return in more detail, right? Secondary ratios. Here, when we talk about return on capital employed, right? Employed, it has two things. One is gross profit margin, right? Operating profit margin and asset turnover. Sometimes companies may focus on this. They may consider this formula as a primary formula and these ratios as a secondary ratios, right? Here, when we often sub-analyze return on capital employed to find out more about, right? So they want to get more insights on return on capital employed. So it's high or low or better or worse than last year. There are two factors that contribute towards return on capital employed, both related to sales, right here. The return on capital employed, these are mainly depends on two things. One is sales, right? One is sales and asset value, right? Assets, more capital, more assets, more capital. More sales, more return, right? So there are two things may think, right? A company make a high or low profit margin on its sales, right? Sales may determine the operating profit. For example, a company that makes an operating profit of 25 per 100 rupees of sales is making a bigger return on its investment, on its revenue, than another company making operating profit just 10 of 100, right? So the sales price may decide. Some people drop the selling price and increase the sales volume and make huge profit, huge sales. Some people increase the selling price and they are having small number of volumes. Anyhow, due to the margin, they are making huge profit. The second formula they introduced is turnover, asset turnover. Asset turnover mean 100 rupees value of assets, how it contributes to make sales. How does these assets contribute to make sales? Asset turnover is a measure of how well the assets of a business are being used to generate sales. When you look at groceries or wholesalers and other business people, they are heavily invest on delivery vehicles and showroom advertisement, right, on that aspects, rather than having owned, right, own building, own office. They are getting office for rental, right, rental purpose. They are taking office rental, but they are they invest heavily on the delivery vehicles and other things, because those assets are contribute directly to the sales, right? When assets are contribute or used for making sales, the company can get more profit rather than getting a luxury building for administrative purpose or production facility. If they invest on sales, they can make more profit. That's why retail companies, retail and other trading companies heavily invested on sales and marketing rather than uh, producing new product. So they just import and sell. For example, if two companies each capital employed 100 million, right? Company A makes sales 400 million per annum, whereas company B makes sales only 200 million. So the double company, but both company having the same asset, same value of assets, but uh, company A make 400, company B 200 million per annum. Company A is making higher revenue from the same amount of assets, and this will help A to make higher return on capital employed than B. Asset turnover is expressed in times, number of times, so that assets generate number of times their value in their annual sales. Here, company A asset turnover is 4 times. The 100 million asset make 400 million sales, right? The assets 4 times used. Here, same asset, but it makes 200 million sales. So the asset used for 2 times. Profit margin and asset turnover together explain return on capital employed. And if the return on capital employed is a primary profitability ratio, these other two are secondary ratios, right? Sometimes they may consider ROE is a primary ratio. The relationship between these ratios can be shown mathematically, right? Here, return on capital employed, this is the formula, right? Profit, operating profit over capital employed. This is the direct formula. No? We can derive the same value by using these two formula. So this formula is what? Operating profit margin. Operating profit margin. This is asset turnover. Right? Revenue means sales, capital employed. You see revenue and revenue. Right? We cut revenue and revenue sales. Then here we have multiplication. Operating profit over capital employed. You see operating profit and capital employed. So we can directly find return on capital employed, or we can, if you want to dive deeply, they use these two formulas for that, to getting more insights. In our example, right? In our example, in the final statement, we can see profit margin in 2018, 11.62, and asset turnover 3.07. Then return on capital employed, you can see exactly what you get earlier. And also same thing, right? You cut this one, right? Sorry, you cut this one and this one. This is operating profit. This is total assets. Total assets, you can get this value. In this example, the company's improvement on return on capital employed between 2017 and 18 is attributable to higher asset turnover. You see here why this year having more ROCE, because you see in the last year the asset turnover is less. This year asset turnover is high, though the profit margin to 17 is high, so 2018 low, right? Even though operating profit, less operating profit, they able to manage higher ROCE, right? Higher ROCE because of this asset turnover. Asset turnover. They invested heavily on sales generating assets like delivery van and billboards, right? Huge billboard, huge things, right? Indeed, the operating margin has fallen in a little, but higher asset turnover has more than compensated for that. It also worth commenting on the change in sales, commenting on sales revenue from one year to the next year. You may already have noticed that Pacific Company achieved sales growth of 60%. Sales growth 60% from 1.9 billion to 3.1 billion. So between these 2 years. So this is a very strong growth. And this is certainly one of the most significant item in the profit loss account. Right? So why this 60% sales growth? Why? Because of they invested some of the asset that boost sales. Rather than investing on the advertisement, sometime they did. They also some sort of assets like they may purchase many delivery vehicles, and you can read about warning about comments on profit, right? You have to think about other aspects, right? Operating profit margin. So there may be I can explain this thing, right? I can explain because it's a warning, no? It's a warning. So it might be tempting to think that the high operating margin is good, right? And low asset turnover means sluggish trading, right? Sluggish trading. In broad terms, this is so, but there is a trade-off between profit margin and asset turnover, right? There we have to be in the middle, right? We will be in the middle. You cannot look at one without allowing to others, right? We have to pay attention in both. First, high operating profit margin, right? For high operating profit margin means say 100 rupees selling price, they are 40 rupees. How much margin? 60, right? Margin 60. So this is higher margin. And another way, 100 rupees sales, but the cost is just 80, or in this way, 40 rupees value of cost, they may sell it for 200, same cost, but 160 rupees margin. Or comparatively, they are having higher margin. All right. So higher margin may give you a lot of profit, but here you can drop the sales. Sales units. Higher asset turnover, right? High operating profit margin means high operating profit per 100 rupees of sales, but if also means that sales price are high, there's a strong possibility that sales revenue will be depressed. So asset turnover a bit lower, right? And asset turnover means the company is generating a lot of sales, but but do this, it might have to keep the prices down. So accept the low profit margin per 100 rupees. So they are making a huge volume, huge sales volume by reducing their price, selling price. So that boost sales. Anyhow, they may go down their margin. Here is an example. Consider the following. Company A and company B. Here sales revenue both. Here this capital employed 10 million both, and operating profit same operating profit. But the thing is sales 10 million A company and sales of B 40 million. Right? These two are the differences. These figures would give you the following ratio. When we look at the ROCE, right, 2 million and capital employed 10. Capital employed here, capital employed 10, operating profit 2. Right, this is 20, both are 20% because here the same, no, these two are same. When we look at the profit margin, right, profit margin, company A give you 20%, right, because high profit margin, so therefore they lose the number of sales. They lose lot of number of sales, so but they able to maintain the margin because of the higher selling price. Now here the sales go up by 4 times than this, 4 times. But here the sales number go up, but margin go down. Only 5% margin. 5% margin. But both of them are having same ROC. Here you see asset turnover, the sales 10 million and capital, right, 10 million, right, asset turnover, capital employed. And you here 4. So asset turnover is high, margin is less. Here margin is high, asset turnover is low. By multiplying these two, you can 20, 5 over 4, 20. So you can get this 20 result, 20 into 1 or 5 into 4. Right? In both way you can get. So when you decide the selling price, actually the margin may impact on the selling price and the selling price and sales volume, right? So you have to keep a trade-off. We have to follow a balanced approach. The company have the same ROC, but it's arrived at a very different fashion. Company A operate with low asset turnover, comparatively high profit margin, whereas company B carries out much more businesses, but low profit margin. This means their sales volume is high. Company A could operating in a luxury end, right? Luxury items, and the while company B is operating at the popular right end customer, right? Popular grocery shops, right? Grocery shop like that. Solvency ratio, actually they don't want its solvency ratios. Right, so we don't want to talk about solvency ratios. I know this. Right, now we come to the liquidity ratios. Liquidity ratios. Here, liquidity mean the company should keep a sufficient amount of money in their hand to handle the day-to-day business operations like paying employee salary, paying utility bills, paying rentals, right? For that, to pay suppliers, right? So they have to keep a sufficient amount of money. So that is called liquidity, liquid cash, right? Simply we call them as a current assets, current assets, working capital. Sometimes we call working capital. Liquid ratios is called working capital ratios. Okay. Profitability is, of course, an important aspect of a company's performance, and gearing, right? Gearing means leverage ratios. Neither, however, address directly the key issues of liquidity. Liquidity mean, so can you tell me, keeping money in your hand is a good or bad? Keeping money in your hand, a big amount of money, 1 million, 2 million, 5 million in your hand, is a good or bad thing?
Not secure.
Yeah, not security aspect, not secure. Even you can put your money into the bank in the current account, big amount of money. It's not a good idea because the companies, companies having money in their hand, if they use that money to buy some of the inventories and they can make sales, of which they can generate some sort of profit. But if they keep a small amount of money, right, small amount of money for business, sometimes they may feel struggle to pay employee salary and supplier payment and other things. So they can't get a discount, bulk discount. When you pay your suppliers on cash, suppliers will give you that product that in a very discounted value. So that the company should keep, right, the balanced approach, not much amount of money, right, in their, not big amount of money in their hand, not a less amount. So they have to keep optimum optimum amount of money, right? So it's a cost. It has cost, opportunity cost. Liquidity is the amount of cash of a company. Okay, so company can put in hand on quickly to settle its debt, the loan, and possibility to meet other unforeseen demand for cash payment too, right? So they have to keep sufficient amount of money, not more or not less, right? Liquid fund. Liquid fund mean liquid cash. So what consists of liquid fund? Cash, right? Liquid cash and short-term investment. If you have, right, stocks in stock market, if you want money, you can directly, right, you can quickly sell the stocks in the market, you can convert into the money. And fixed term deposit less than 1 year, right? It should be less than 1 year, so that you can quickly convert the certificate fixed deposit into money. Trade receivable. When you do sales, credit sales, your customers will return that money in 30 days, 60 days, or anyhow within 1 year. So that can be considered as a trade receivable. Because they will pay the dues within a reasonably short period of time. Bill of exchange, right? Bill of exchange like checks, because the ordinary trade receivables, this no, your supplier, your customers may give you checks and other promissory notes, promising that I can settle that money within a very few short period of time, like that. In summary, liquid assets are current assets, right? All current assets may be considered as a liquid assets that will could soon be converted into cash. Any assets, right? But when you compare the land, it is not liquid assets. You have to find some of the buyer to buy this apartment. Those are illiquid assets. You can't convert within a very short period of time. But if you have gold in your hand, stocks, shares, right? So you can quickly convert them. So those are liquid assets. All current assets without exception, all current assets, right? Sometime, right, the people refer liquid assets. Some people refer all current assets, all current assets. Sometime, the inventories cannot be sold quickly, right? Some inventories. So to convert the inventories into cash, you have to make a discount offer, right? Discount sale, year-end sale, clearance sales. So if you do, only you can convert those assets inventories quickly into the cash. Other than that, so it's very hard. So that many professionals, when they are calculating liquid assets, they may exclude inventories. So that current assets minus inventories. Right? There are two approaches. This is one approach, two approach. A company can obtain liquid assets from a source other than the sales of goods, right? And services such as issue of shares, right? Sometime company can get cash by selling, by issuing, not selling, by issuing new shares like IPO and SPO, a new loan, new bank loan, or sale of non-current assets. Sell non-current assets mean the vehicle, machines, they can sell and get money. The thing is, it cannot be done, it can be performed frequently. But a company cannot rely on these all items. And in general, obtaining liquid fund depend on making sales revenue and profit, right? So the company can keep cash. That cash should come from making sales, not by issuing new shares or not by getting loan from the bank or not by getting selling of its non-current assets. It's wrong, right? So they have to generate sufficient money to run the business. That money should come from sales, right? Even profit do not always lead to increased liquidity, right? Profit not equal to cash, right? You can make sales, but every customers bring all their items, inventories on credit basis, so that you can record them the credit sales as a profit, right? But even though your account shows them as a profit, but you are unable to make the cash. You have to wait until they pay. It is mainly because fund generated from trading may immediately invested in non-current assets or paid as out of dividend. Sometimes what people do is they make sales and generate cash. That cash should be used for working capital, right? Buy other inventories and pay salary. Rather than that, what people do is some people mismanagement. They buy non-current assets or pay as dividend. It is not always not ideal. The reason why company needs liquid assets so can meet debt when they fall due. Payments are continually made for operating expenses and other costs like salaries and wages. So there's a cash cycle we will discuss, cash cycle from trading activities of cash coming in from sales and cash going for expenses, right? The cash generated by sales cannot be used for non-current assets or paying as a dividend. So it should be used for settling suppliers and other operating expenses, say paying employee salaries. Right. Now let's see cash cycle. Cash cycle here. Before that, I give you a small intro on cash cycle. Right. So this is cash cycle. So first, what people do, right, in the fix, once they get money, what they do is inventory, right? They purchase inventory. The purchase of inventory they may take 30 days on credit terms, right? First, they buy inventory and the inventory will keep for a period of time until it make into sales to customers, sales to customers, right? This inventory keeps in the store for 90 days, 90 days, right? So at this moment you made on credit, the sales you made on credit, the customer said he will pay this money in 10 days, 10 days, right? So the money, right, the original money or original money, today you buy the inventory today and keep this money, keep this inventory in your store for 90 days. And after 90th day, you sell the product and the customer will pay the money, customer receives from the customer, right? Money. So almost 100 days. You have to wait 100 days to convert your money into sales, right? So here money go out, here money get in. So it takes 100 days. It takes 100 days. You can shorten this period. How? You can shorten this period. You can, rather than you pay by cash to supplier, you can request, right? You can request 30 days credit, 30 days credit from your supplier, right? Here, what can you can do is you can settle your money on 30th day. 30th day, you can shorten the cycle. Now, 100 days minus 30 days, only 70 days. Your cash conversion cycle 70 days. You don't want to wait 100 days, right? You don't want to wait for 100 days. But if you buy the material for cash, by cash, you have to wait 100 days. But if you get 30 days credit from your supplier, you can shorten the case conversion cycle by that day. So if 30-day supply credit, you can make it into 70, 100 into, right? So with this note, let's see the cash cycle. To help you to understand liquidity ratio, it is useful to begin with a brief explanation of cash cycle. The cash cycle describes the flow of cash out, flow of cash out of a business and back into it again as a result of normal trading operation, right? So buy inventory and sell inventory. So buy inventory cash go out and sell inventory cash get in. Cash out to pay suppliers, wages and salaries and other expenses. Although payment can be delayed, you can delay the payment by taking some credit from your supplier. A business might hold inventory for a while, right? They can keep inventory and sell it. Cash will come back into the business from sales, although customers might delay payment by themselves for asking credit, right? If it is not cash payment, it is not cash sales. If they made cash sales, you can get your money back here, right? Cash sales. So it's extended by 10 days because you gave credit to your customer. So the main points about the cash cycle are as follows. The timing, right? The timing of cash flows cash flow in and out. So when your cash go out and get in, for business does not coincide with the time when sales and cost of sales occur. Cash flows out can be postponed by taking credit, right? You can apply for a credit term. Cash flow in can be delayed by having receivables. The time between making purchase and making sales also affect cash flows. If inventory is held for long period, right? Your inventory, your items keeping long period. The delay between cash payment of inventory and cash received from selling also being long, right? So the inventory is hard to convert into cash. Holding inventories and having receivables, inventories and receivable can therefore seen as two reasons why cash receipts are delayed. So why here, when you look at here, when you purchase inventory on this date and you have to wait for this period to sell, and even you sell, you have to wait for a period of time to make into cash. What happened? You purchase inventory today and sell it tomorrow. At the time of sell, you get the cash. So in this scenario, you can convert the cash in 2 days. In 2 days, cash sales. So why is got delay? You keep the inventory for long period, 90 days, and again you keep the customers giving credit for 10 days. So it's make it longer. If you shorten the period, right? Shorten the period, and you can shorten the case conversion cycle. Similarly, taking credit from creditor supplier can be seen as a reason why cash payment are delayed. Right, you can shorten the period, right, rather than give it for 30 days. If you get approval for 60 days of credit, then what you can do is your case conversion cycle 100 days minus 60 days, then you can make it 40 days. Right? 70 days conversion cycle become 40 because you get more period to settle your customers. So to enhance your working capital profitability, what you have to do is you have to keep inventory which are short, right? Within short period of time, you can sell it and eh, make cash sales, then credit sales. And again, you have to get extended period of time to settle their bills to suppliers. The company liquidity position will worsen when it has to pay suppliers, right? So therefore, better to get more loan unless it get more cash from the sales and receivables. The liquidity ratios and working capital turnover ratios are used to test a company's liquidity, length of cash cycle, and investment in working capital. The cash cycle is also referred as to the operating cycle, right? Operating cycle. Now we approach your assessment here, this part. So we already discussed gross profit and net margin. Now we talk about current ratio, asset ratio, right? And working capital efficiency metrics, inventory days, we look at this. Now, right, a liquidity ratio. The first formula is current assets divided by current liability, right? Current assets divided by current liabilities is a direct formula. Normally they take some textbook recommend it should be 2, right? This textbook recommend 1, but maintaining, right, 3 to 1 is ideal, right? Not more than this 3. It's based on the nature of the business. For example, if you look at the Food City, Cargill's Food City and other retail shops, the inventory period is very short, right? Within a few weeks, they sold the items, say sugar, milk powder, right, coconut powder, and soft drinks, yogurt. So this kind of inventories quickly they sell it quickly. Right? So therefore, and also the grocery and supermarket, they don't have credit sales. Very rarely happen credit sales, no credit sales. So the inventory period is short and no receivables, so that they can keep minimum working capital. The idea behind that is that companies should have enough current assets that give a promise of cash to come to meet the future commitment to pay its liabilities. So here they have to pay only to the suppliers and the employees. Obviously, ratio in excess of one, right? Current assets, say 100 assets, 100 liability, 100 payable, 100 receivable. So it's one of, so keeping at this level is fine. Otherwise, there will be a prospect that company might be unable to pay its debt on its time. So if it is less than, say for example, we have 70 rupees receivable, we have to pay 100 rupees payable, then it's very hard. That it's very hard time, right? We have no sufficient working capital liquid to pay. So ideal one is one. In practice, ratio comfortability in excess of one, more than one should be expected. But what is comfortable varies between different type of business. Some businesses need more than two, more than three, like that. Some business like supermarket uh, is small enough. Companies are not able to convert all current assets into cash very quickly. In particular, some manufacturing companies like garments, right? Companies might hold large quantities of raw materials, thread, right, clothes, everything, which must be used in production to create finished goods of inventory. So these might be warehouse for long time, right? They have to keep the assets, the inventory for long time, sold on lengthy credit, right? Uh, 6-month credit. In such businesses where inventory turnover is low, right? Inventory turnover is low. Most inventories are not very liquid assets because cash cycle is so long. For these reasons, we calculate an additional liquid ratio known as asset ratio, quick ratio or asset ratio. Here, current assets, we exclude inventory. So because inventory, it's not reliable. So it takes some time, years to solve. And current liabilities. Earlier ratio, current assets over current liability. Now the quick ratio or asset ratio, the same formula, but we deduct inventory from the current assets. Right? So look at this sentence and give me 1 minute. Okay. The ratio right here. So this quick ratio can be not more than one, not more than two, right? So ideally is one. The ratio should ideally be at least one for companies with slow inventory turnover. For companies with fast inventory a quick ratio can be comfortably less than 1, right? Say 0.8, 0.7, also accepted. Without suggesting that company could be in the cash flow trouble, right? So 0.7 also acceptable, right? Both current ratio and quick ratio, current ratio without inventory, so with inventory, quick ratio without inventory, offer an indication of the company's liquidity position. But the absolute figure should not be interpreted too literally. It is often theorized that acceptable current ratio is 0.1, 1.5, and the acceptable quick ratio is 0.8. But these should only be used as a guide, not a strict rule of thumb. Different business operate in a different ways. Say supermarket group, for example, might have a current ratio of 0.52, quick ratio 0.17, right? Supermarkets have low receivable because people do not buy groceries on credit. Low cash, right? Good cash management, right? They not keep big amount of money in hand. They buy inventories and they can sell it very quickly. Medium inventories, right? High inventories but quick turnover, particularly in the view of perishability. Sometimes it may got expired soon and very high payable. Give me 1 minute. Sir, sir. Right. Um, so in the supermarket, normally they are not keeping inventories, so which are expired quickly. For example, milk, fresh milk, and yogurt, and vegetables, fruits. So this lifetime is very short, so it's perishable. So the inventory, right, can convert it to cash very quickly. Compare this with the manufacturing and retail organizations. With the current ratio of 1.44 and quick ratio is 1.03. Such business operate with a liquidity ratio closer to the standard. So this is fine for the manufacturing companies, right? But for retail, retail means like food cities and supermarkets. Uh, these are ideal one, right? These are ideal. It's not serious. So it's mean there's no rule of thumb. It's based on their industry. So what is important is the trend of these ratios. From this, one can easily ascertain whether the liquidity is improving or deteriorating, right? If a supermarket has traded for last 10 years, it's very successful with the current ratio 0.52 and quick ratio 0.17, then it should be supposed that company can continue business with the level of the liquidity. So it's not ideal, but it has a long history, long successful history, so they can manage. If the following year the current ratio will fall to right 0.52, from 0.5 to 0.38, and quick ratio suddenly fall 0.03, it's terrible, right? Actually, it's terrible. Then further investigation into the liquidity situation would be appropriate. It's terrible. It is relative position that is far more important than absolute figure, right? So by just looking at their quick ratio, current ratio for that particular time, It's not sufficient. You have to compare. You have to compare either with the previous period or with the competing similar firms, right? So you have to interpret. So my emphasis is always you have to perform horizontal and vertical analysis. Both you have to analyze for any decision. You have to uh, consider the trend, the past period, as well as competing firms. Right? Do not forget the other side of the coin. The current ratio and quick ratio can get better than they need to be. A company that has large volume of inventories and receivables might be over investing, right? So they purchase a big amount of uh, inventory, but it's take a lot of time to make sales. In the meantime, they make credit sales and give a long period of receivable, right? So all of your money in outside and in the right debt, your money, all of your money dumped as inventory and dumped into receivables. So you have to wait for a long period of time. This is called over investing, over trading. Sometimes it's called over trading, over trading, and is tying up more funds in businesses than it need to. So this would suggest poor management. It's a poor management of receivables or inventories by the company. Right. Now we look at the cash collection period, inventory turnover period, and suppliers payment period, right? So here I gave you that hypothetical image of finding cash conversion cycle, right? But here I will give you how to calculate this days, 90 days or 2 days like that. So here we have to talk about we talk about here. So we discussed current ratio, asset ratio, ROC. Right now we are going to work out on current capital ratios. Inventory days, receivable days, payable days, and cash conversion cycle. Right. After that, we can finish it. So based on these calculations, we have to do the interpretation, and then so these are your. So this is a skill of calculating the ratios. This is application of in-depth analysis of reporting, and this is your strategic uh, mind. Efficiency ratios, account receivable and collection period. Account receivable collection period. A rough measure of average length of time it takes for a company's customer to pay what they pay, liable to pay account receivable collection period, right? One customer purchase something and he asked time, he required time to settle that money. So if you give 30 days, so you give 30 collection period is 30 days, your collection days. But the thing is, not always you give 30 days, you may give 30 days for some customer, 50 days to another customer, 10 days on another customer. So may differ. So therefore, we have to find average collection period. The estimated average accounts receivable collection period is calculated as trade receivable divided by sales into 365 days, right? Trade receivable, right? Trade receivable you can take from balance sheet. It is taken from profit loss account. And some people take 360 days, right? Uh, right? It may differ textbook to textbook, right? Some people it is in 52 weeks or 50 weeks, like that. The figure for sales should be taken from the sales revenue in the statement of profit loss account. Note that any cash sales should be excluded, right? So the credit sales, the sales should not include cash sales, right? Should not include cash sales, right? This ratio only uses credit sales. The trade receivable are not be total figure for the receivable settlement, so which include prepayment. So in the receivable as well, trade receivable, you should not include any advance payment, prepayment, and non-trade receivable like loan given to employees, loan given to employees. So those are not included here. Trade receivable figure will be itemized in an analysis of receivable total. And not so you can find so what are the elements in the trade receivable you can find in the notes of the fund statement. The estimate of accounts receivable collection period is only approximate, not correct figure. The value of the receivable in the statement of financial position might be abnormally high or low compared with normal level of company has usually has. Sometimes due to some events, skewed events, sometimes may be overstated or understated. So you have to consider that as well. Sales revenue in the statement of profit loss is exclusive of sales taxes, right? Sales tax, but receivable, right? You have to exclude, you have to remove that like VAT. You have to exclude VAT, TT, and but receivable in the statement financial position inclusive of sales tax, right? So the customer receivable, including VAT, you can include. We are not strictly comparing like by, right? So this is no rule of thumb of exclude or include the taxes. Sales are usually made on normal credit terms of payment within 30 days. A collection period significantly in excess of this might be a representative of poor management, right? Normally, your policy is 30 days, giving collection period for 30 days to a customer. When you do the ratio analysis, if it is come for like 35 days, 40, 45 days, then it's meaning you are in poor management, poor management. However, some company, right? However, some companies must allow groceries credit terms to win customers. Exporting companies in particular may have to carry out large amount of receivables. So their average collection period might be excess of 30, right? So in the international business, to attract more customers, they may give for the long period. The trend of collection period over time, right? So last year, 20 days, this year, 25 days, next 30 days. So you have to observe this kind of, right, this trend is probably the best guide. If the collection period is increasing year on year, this indicative of poor management, poor credit control function, and potentially therefore poorly managed company. So it is not a good sign. For 2019, 21, 18, it's good sign. Right here, using the same type of company as an example, right? Here, you see the trade receivable and sales. You supermarket, you see collection days 6.4 days. Why is that? So normally supermarkets do not give credit, right? Customers, but there are some employees within their food city or supermarket, they can get some items on credit basis and they can settle by when they are in their salary. So that is rarely occur. The last year it was 5 days. Now it's 6.4 days. In manufacturing firm, It's normally 81 days, last year 78, and sugar refiner and seller 29 days, and last year 31 days. The difference in collection period reflect the differences between type of business, right? Here, supermarket hardly take receivable, right? It's very rare. So that's why it's what. Whereas the manufacturing companies have far more, right? 81 days, almost 3 months. The collection period fairly constant, right? So when we look at these two periods, no much significant. The collection period are fairly constant from previous year to all these companies, right? So this is how we have to interpret the efficiency collection period. Now the second part, inventory turnover period. Inventory. Another ratio worth calculating is inventory turnover period. How long we keep the inventory in our warehouse or showroom. This is another estimated figure obtainable from published accounts, which indicates an average number of days that item of inventory held for, right? How many days the inventory in our warehouse. As with average receivable collection period we did earlier, it is only an approximate estimate figure, but one which would be reliable enough for comparing changes over the year. Right. The formula earlier we talked about, so the numerator coming from financial position, right, balance sheet, and denominator is coming from profit loss account. The inventory, average inventory divided by cost of sales, not purchase, right? Not purchase, cost of sales. Cost of sales. This is another measure of how vigorously a business is trading. A lengthening inventory turnover period from 1 year to the next indicates. It's a slowdown of trading, and it gives us the information whether the inventory is trading very slowly. A build up in inventory level, perhaps suggesting that investment in inventories become excessive, right? It's a long period mean slow movement, slow moving inventory, plus the company has dumped their money in the inventories. Generally, higher inventory turnover. Inventory turnover means turnover. How many times the inventory turned, right? You buy inventory, you keep the inventory for 30 days and sell it. So if you do so, in a year, you can make 12 times, right? 12 times. If you sell the inventory within 15 days, we can make turnover 24 times, right? So when you make short and shorter, we can make many times inventory turnover. So each turnover give you profit on that. More turnover, more times you are changing inventory, and you can make more profit. So that's why people do discounted sales. So generally, the higher the inventory turnover, the better. Higher inventory turnover is better. That is lower the turnover period, the better. But several aspects of inventory holding policy have to be balanced. Lead times, seasonal fluctuations, alternate use of warehouse spaces, right? So you have to consider all these things as well. And bulk discount, sometimes the the retail shop owner want to buy it in bulk, so they can get huge discount, 50 discount, or buy one and buy like that. Likelihood of inventory phasing or becoming obsolete, right? Even though they are giving a huge discount, if you purchase items which are quickly become out of date, expired, so that is not ideal decision. to buy in bulk. It is usually if we add together inventory turnover period and receivable collection period, this should give us an indication of how soon inventory is converted into cash. Both receivable collection period and inventory turnover period, therefore, give us further indication of the company's liquidity. You see here. Right, you can see from this picture, right? So inventory turnover period, into inventory period here up to this. This is collection period. Days of inventory on hand and days of sales outstanding, the cash receivable, cash flow, right? So these two, right? So if you shorten the inventory holding period and if you shorten the collection period, you can reduce, right, case conversion cycle period. Right, how we can shorten it? We get this aspect, suppliers, so we can deduct this period. Right, we see one example. Inventory turnover period. Say company, this is supermarket. Here they have 23 days, 22 days. This is 19 days, right? Supermarket is they have less than 1 month for groceries. Some 6 months, so like stationaries, right? When you take the manufacturing company, it's maybe 80 days, 90 days, like that. The next part is account payable period. Now we are going to talk about this aspect, this one, this aspect. Supplier, right? Supplier. So we purchase inventory on this day and we settle the payment on this day. So we take some credit terms. So how long? Account payable period is ideally calculated by the formula. So trade account payable, right? How much we are payable, and credit purchase into 365 days. It's rare to find purchases disclosed in published account, right? You can't find this. So cost of sales serve as an approximation. You can take cost of sales. The payment period often help to assess a company's liquidity. An increase is often a sign of lack of long-term finance or poor management of current assets. Resulting use of extended credit term, right? The companies try to get items from supplier for extended period. Earlier, if the supplier gives 30 days, if you are managing good your working capital, you can make it 40, 50, 60, right? If you have bond with supplier for long period, so they will extend the credit as you build trust with them, rather than going for a bank overdraft, applying for a supplier for extended credit terms. It will be more beneficial. Right here, the questions regarding liquidity and working capital management, where we can find um, receivable collection period, inventory turnover period, and uh, uh, supplier, right, credit payment period, right? So that receivable collection period, we need uh, trade receivable divided by sales. This is inventory divided by cost of sales, and this is trade payable divided by cost of sales or purchase. So by looking, so we may, for example, if we get 90 days, inventory say 20 days, and total length is 110, and we deduct this collection, sorry, credited payment period, say uh, 50 days, 50 days, then it should be 60. So case conversion cycle is 60 days. So this is how we can find it. So here they give some of the right notes. The trade receivable is given and trade payable also given. And so this is accruals. And example question 2 and 3 also is operating cycle. Operating cycle means operating cycle, say for example, how do we calculate operating cycle? Yeah, case conversion cycle, right? Operating cycle, this is called operating cycle, case conversion cycle. Case conversion cycle equal, right? Operating cycle. Operating cycle. For example, if you find, say, inventory holding period, say 20 days, and customer, right, collection period, customer collection period, say 15 days, and supplier payment period, say 10 days, then case conversion cycle could be how much? 5 and 25 days, right? 25 days. Case conversion cycle is 25 days. Then how many times we can run the business? You see, in a year, there are 365 days. Each cycle requires 25 days. Then how many times we can rotate? Yeah, you do a business. So this is called a case conversion cycle, right? This is case conversion cycle. This is how many times you are running the business in a year. So that is not necessary here. So this is how calculating case conversion cycle, right? Yes, payable period, case conversion cycle, right? Other than that, no need anything. Efficiency, return benchmark, right? I hope I covered everything in your syllabus, which are sufficient to write your assessment, all of your assessment. I prepare my session according to their assignment, your assignment. So if you have any questions, you can ask now. Please, if you have any questions, I'm happy to answer.
Benefit,
Yes.
when is the payment submission date?
Uh, According
Based
to
on
the
the, yeah, it is 23rd, right?
yeah 30th, I think 30th
Oh,
November. So please check the date in LMS, or please confirm with the course coordinator.
yeah, okay, sir. Thank you.
Any other things? Okay, I'm free to interact with you anytime. If you have any queries, please give me a call or send me a WhatsApp message. I can help you. So with this note, we can wind up the class, and I wish you all the best for your future endeavors. Okay,
Thank you so much.
you're welcome.
Thank you, sir.
You're welcome.
Thank you.
Welcome. Okay, I wind up the class. Thank you. Welcome.